monthly chart of gold or silver, it's really violent sideways. So how do we come up with this 3 to 500 nonsense, right? Because that seems silly. Silver's lagging, but there's a point at which during that trend, silver spread versus gold breaks out in a clear way. At that point, usually both metals then accelerate, but silver far more than gold. Silver said, hey, I'm beating gold now. I'm no longer the dog. The fundamentals are often lagged in creating the reality. But silver supply demand has been in deficit. The new silver versus the demand has been in consistent deficit for like 5 years now. They can't produce enough silver. And it's also in the AI generation stuff, the big plants are being built and so forth. There's a lot of silver in it. And we know these factors are out there. We know the monetary measurement of silver says you could go ridiculous on the upside, or at least seemingly ridiculous. Go to $500. It will occur very quickly, within a couple quarters. People forget that silver is not just an industrial metal. It behaves like gold. And bought gold at 5,200. They got bagged.
You've recently, in interviews, been stating that you think that gold and silver are probably going to reach new peaks in summertime. Is that some of your logic? You've thrown out numbers like $300 to $500 silver by summer. Yeah. Is that? I don't want to misquote you.
Yes, I still assess that. I think that the break we had mostly in one day, January 30th, 1st, last day of the month of January. Most of the break occurred then, 90% of it, one day. And since then, if you stand back and look like at a monthly chart of gold or silver, it's really violent sideways. In a wide range for silver, a less wide range for gold, but it's just really been net sideways.
Daily chart of gold. Okay.
Daily,
so
yeah.
This is the day you're talking about here, the peak
right there.
Yeah,
that big day. And then there was some follow through on the first day of February, but basically most of the break occurred in 2 days.
Yeah.
Back to the two big red candles here. And then since then you can draw a line sideways and you're short, you're winning. Oh, suddenly I'm not winning. You're long. Oh, got stopped out. First off, we argue that the market drop in January was likely to occur. We thought it might occur later, like in April or so, based on our timing assumptions about this major surge in the monetary metals. We define it as having commenced really big time in November of last year. For silver,
a one-day collapse shaping an entire narrative should immediately raise questions about who was positioned beforehand. As Michael Oliver points out here, 90% of the move happening on January 31st suggests a liquidity event, not organic price discovery. When markets go violently sideways after such a move, it usually reflects trapped positions and institutional repositioning, not stability. Investors chasing direction in this chop are effectively feeding volatility, while larger players reset exposure quietly. The bigger issue is timing. November marked the real shift, but most participants only reacted after the damage. Next, Michael Oliver discusses how momentum signals quietly confirmed that shift before price did.
That was our final long-term buy signal. If you get a silver chart somewhere.
Boom. There we go.
Go to a weekly would be best if you could do that.
Okay. Weekly, done.
Yeah. Okay. In the last several years, we put out three major long-term based technical buy signals. One was back in 2024 after silver dropped down. Let's see, that would be, 24, April of 24. Yeah. Yeah. In 24, we were coming up. See the ceiling there at about $26?
Yeah.
So yeah. Well, when we came up there in March of that year, just to the right of where you were then, we said we're going to break out. We didn't wait for the breakout, which means taking out 26 or 27. But we said, and we got up in the 25, 26 zone, said, okay, the market's going to start to accelerate now. Okay, that was at about $25 to $26 zone. Okay, mark
24, that. 25, $26.
Then we had that first surge, got up to 30 something again, right in the middle of the 50-year range, silver. And in the sharp drop in June of 2020, no, in April, May of 23. Yeah, right there, that drop there. When we turned up out of that hole, we said you get back up into the 34, 35 zone, and it had already been over 35 twice in the prior year. But that in June of 2025, it was coming up through 34 again. And we said, okay, next major buy signal. Okay, that's our second one. The third one occurred in November of last year. November of last year, price was closed that month at $56. 56 and change. Yeah, that bar. That was not based on the momentum of silver. That was based on a spread relationship between silver and gold, meaning you plot an ounce of silver, divide it into an ounce of gold, express it as a percent. And at that point, when we plotted that chart, silver was breaking through a massive ceiling of prior spread relationships to gold. And it said, oh, I'm going to accelerate against gold. Well, in the past, when that has occurred, like in the mid 79 to 80 surge, or in the 2010, 2011 surge in silver, both of which peaked at 50. In the midpoint of those sharp advances, the spread broke out, meaning silver said, hey, I'm beating gold now. Okay, I'm no longer the dog. And
this is that point you're talking about right here is for 10
well,
years it was trading in this range.
And actually, we had another one at a lower level too, but that's okay. But at $56 was therefore our last buy signal.
Okay.
And this one was based on the spread relation between silver and gold. With the prior knowledge that in the past, whenever you have both markets going up, silver and gold, and silver's lagging, but there's a point at which during that trend, silver spread versus gold breaks out in a clear way.
Breakouts rarely begin at the breakout. They begin when no one is paying attention to the setup. As Michael Oliver points out here, the real signal wasn't price crossing, 56 saw, but the structural shift in the silver to gold ratio, something most retail investors never track. Historically, these ratio breakouts, like 1979 and 2011, marked the midpoint, not the star, of explosive moves. That means by the time headlines catch up, a significant portion of the upside is already priced in. Investors focused only on price levels miss the underlying momentum shift, driving capital flows between metals. Next, Michael Oliver unravels why these mid-cycle signals often precede the most aggressive phase of the move.
Yeah.
At that point, usually both metals then accelerate, but silver far more than gold. Well, silver went from $56 to well over, 120 in a matter of a couple months.
Yeah.
Yes, it pulled back into the 60s briefly, 2 times now. Now we're in the mid 70s, 76 area. But we're no longer issuing any major long-term buy signals. If you want to get long now, you're a late comer, but there is a lot more to come because our analysis of prior such moves in silver, even the ones that were confined in that 50-year depressed price range, $4 to 50, $4 to 50 for 50 years. The surges that occurred even within that range lasted a couple quarters, and they were usually signaled a couple quarters before the surge ended by the spread breaking out, silver versus gold. So how do we come up with this 3 to 500 nonsense, right? Okay, that seems silly. If you go back in history, you can find other markets that had similar I'm out of here type breakouts where they'd been confined in a price reality for so long, for decades, and suddenly they decided on their own, didn't need help from other markets. Copper did this in 2005 to 2006.
The uncomfortable truth is that by the time most investors feel confident, the easy money is already gone. As Michael Oliver points out here, silver doubling from $56 to $120 in months reflects a classic late-stage acceleration, not an early opportunity. Historically, these parabolic phases compress gains into short windows, often just a couple quarters, leaving late entrants exposed to sharp pullbacks. What's rarely said is that volatility increases precisely when conviction peaks, trapping momentum chasers. Comparing this to copper's 2005 to 2006 breakout highlights how quickly sentiment can flip from disbelief to euphoria. Next, Michael Oliver talks about how extreme price targets are actually derived from long-term structural ranges.
There's another way to do it. If you look at a silver chart on a log scale, you've got an arithmetic scale there. But put on a ratio scale, going back to the 1970s. Yeah, there's your two peaks.
Okay, right here.
And the bottom of the range is down around $4. Okay.
Yeah.
Yeah, there. Okay, so you got a range that's what's the difference between the highs and the lows? About a tenfold.
Yeah.
Plus, okay. You break out of that range and do a swing objective of it, a simple price chart technique. And it says, gee, I go to $500.
Okay.
A tenfold, break out of the range, go tenfold. Okay. Don't be shocked by it. And we also know that in the last 4 or 5 years, fundamentally, and this is something we don't keep up with because, frankly, the fundamentals are often lagged in creating the reality. But silver supply demand has been in deficit. The new silver versus the demand has been in consistent deficit for like 5 years now. They can't produce enough silver. And we have strong industrial demand. Used to be it was for photographs. Remember that? I don't know if you remember that far back or not. And then now it's solar development around the world. In the photovoltaic cells is silver. And it's also in the AI generation stuff, the big plants that are being built and so forth.
A $500 price target sounds extreme until you realize it's rooted in decades-long structural compression. As Michael Oliver points out here, a 10x move isn't arbitrary. It's derived from a 50-year range between roughly $4 and $50, now potentially breaking higher. What's often ignored is that fundamentals like a 5-year supply deficit and rising industrial demand in solar and AI lag price, they don't lead it. By the time supply shortages are obvious, markets have already repriced aggressively. The real risk isn't whether silver can spike, but how fast it moves when liquidity shifts. Next, Michael Oliver discusses why these explosive moves tend to accelerate late, not early.
A lot of silver in that. Anyway, that's not our issue. But we know these factors are out there. We know the monetary measurement of silver says you could go ridiculous on the upside, or at least seemingly ridiculous, go to $500. Our assumption is that it will occur very quickly, meaning within a couple quarters probably. Well, our clock began when? After the close of November. That's when the spread broke out. So these Jan, Feb, March, April, May, okay? Maybe another month or so, I don't know. But, there's a couple quarters, let's call it. Maybe 3. But dramatically. And not go from here to, let's say, 3 to 500 over 3 years. It will have a tantrum. It's already showing some signs of a tantrum here. You can look at the chart.
Yeah.
Anyway. So that's the reality we see, and we're only, on the clock, maybe halfway through that process. And quite often what happens in the latter part of that couple quarter explosion is where most of the price increase occurs.
Okay, so you're you're basically seeing that you're looking back at past price action, of which you've seen it in lead, you've seen it in copper. When we got that ratio breakout from silver to gold, which also coincided with the price breakout, that was kind of a double whammy.
Yeah.
I guess it wouldn't be unheard of if it did the same thing as copper and it did the same thing as lead has done before.
The market rarely moves slowly when structural pressure finally releases. It snaps. As Michael Oliver points out here, the expectation of a move to $300 to $500 within just a few quarters signals a liquidity-driven surge, not a gradual bull market. Historically, late-stage commodity runs compress most gains into the final phase, meaning investors waiting for confirmation often enter at peak risk. The comparison to copper and lead isn't casual. It highlights how fast capital rotates once momentum aligns with positioning. The real danger is mistiming that acceleration window. Next, Michael Oliver discusses why monetary forces, not industrial demand, ultimately drive these explosive moves.
Sure. And there's underlying monetary factors as well. People forget that silver is not just an industrial metal. It behaves like gold. A lot of people like to think of silver as an industrial metal, therefore, it goes up and down in recessions. Well, first off, that's not true. And secondly, commodities can go up during recessions, as the late 70s proved to us, and other times as well. You have a global recession and commodities explode, okay? The key factor underlying silver, I think, is monetary. The industrial is a side event. Important, but not the primary. And when gold goes up, silver goes up. The issue is which one goes up more and faster. And silver has been lagging, and now it is not. And I don't think it will lag in the next several quarters as well. You'll see more drama there than you will in gold on the upside.
Okay. All right. Well, I got to say, from our last talk, we did with premium subscribers, we took some leaps on silver miners. Those worked out quite well. So thank you for that. Maybe it's time to take some more.
I think the congestion zone is done on the downside.
The biggest misconception in commodities is believing demand alone drives price, when liquidity often tells the real story. As Michael Oliver points out here, silver, behaving like a monetary asset rather than just an industrial metal, changes how investors should frame risk, especially heading into potential recession cycles. The 1970s showed commodities can surge even as economic conditions weaken, contradicting mainstream narratives. When silver stops lagging gold, it often signals a shift in capital preference toward higher beta assets. For portfolios, that means higher upside, but also sharper drawdowns. Next, Michael Oliver unravels how stop runs and market traps reveal where smart money is positioning.
In other words, we had this violent range, and about a month ago, or 3 weeks ago, we put out a report and we suggested that, hey, the February low on gold was 42.23. We said, it's too obvious. Let's go take it out and run some more stops. In other words, anybody who bought late on silver or gold, didn't buy it at 30 or 25 or 30 or 50, or they bought silver at 110, let's say, and bought gold at 5,200. They got bagged, okay? But there was that low in February that we held above all during March, and finally we started to approach it again with the war event. We said, take it out, run the stops. And if you look at the hourly action the day we ran those stops, it spent like 2 hours or so below the February low and then right back up again. Both silver.
You're talking about this bar right here, right?
Yeah, that bar right there. See, one day took out the Feb low.
Yeah.
Immediately said, I've had enough. Okay?
Here's the hourly chart. So
it literally was
90 minutes
hours
or something, and then we're back up to
that low was 42.23. So the prior to the Feb low. So it literally was a couple hours below it. And then you immediately said, I'm back above it. Same with silver. Its low had been like 66, went down to like 61 something.
When markets dip just long enough to trigger panic, it's rarely accidental. It's engineered. As Michael Oliver points out here, the brief break below the February low around 4,223 wasn't sustained selling, but a classic stop run designed to flush weak hands, spending barely 90 minutes below key support before reversing signals aggressive institutional buying into forced liquidations. Retail investors who entered late, buying near $110 silver or $5,200 gold, were precisely the liquidity needed for that move. These events expose how price discovery often masks positioning games. Next, Michael Oliver discusses how these fake breakdowns often mark the real bottom, not the start of further declines.
Yeah.
And
right
look
here
at the low to your left there, the Feb low. Yeah, right there. And see, look, what'd you spend, an hour or two below it?
Yeah. Maybe 75 minutes.
Just enough to sting everybody out.
Yeah. Okay.
And then you pop back up. And, I suspect that was the low.
Okay.
Now the issue is, okay, how long is it going to take us to get up and make it clear to investors that, okay, we're going up again?
Yeah. Okay.
Well, obviously, you go back to the high, everybody's going to realize it. That's an idiot level. Okay.
Yeah.
But if you looked at gold on a close-only basis, the mama market, daily closes, just the closes, if you can do that. Continuation chart. Now, I don't know if you got April or a continuation here, but there was a high close back in January. that was at 5,300 plus, high daily close, just prior to the big bloody down day. Okay.
Okay.
It was a high close right there,
right in there,
5,300 and change. Okay. Then you drop down, then you come back up. And in March, on a continuation basis, you had another close that was above 5,300.
The market doesn't reward clarity early, it waits until most participants feel safe again. As Michael Oliver points out here, reclaiming and holding above prior closing highs near 5,300 is less about price and more about restoring confidence after engineered volatility. The emphasis on closing prices strips away intraday noise, revealing where institutional conviction truly sits. Historically, repeated closes at highs signal accumulation, not exhaustion, especially after sharp shakeouts. For investors, waiting for obvious confirmation often means buying after the move is already extended. Next, Michael Oliver shows why reclaiming these levels could trigger a broader recognition phase across the market.
So on a close-only basis, you basically eliminate the highs and lows, look only at the closes. You got two peak closes above 53. I'll tell you what, you ever get back above 53 again, it's not going to stop this time.
Okay.
And it's definitely not a top for the people who have to see a price chart evidence of that. So that's a level that will wake them up. We've already had momentum levels that have been crossed that suggest that was the low we just saw, and we're on our way back up. And for silver, the level that's important for price chart guys now, not momentum, is getting above 90, because you'll see after the Jan break, you've had three rallies that probed up over 90.
Yeah.
Right after the break, there was a rally that got above 90. Then there was that rally there. There's one, got above 90, and then go over to your right a little more, and that got above 92 on that day. It traded there early March. And then you went down. So three times you've posted action above 90. Don't go back there a fourth time. Forget the isolated high over there. You get back over 90 again, it says, hey, I'm coming through this time. I'm persistent. You go back and study tops in gold, for example, through history. You don't go back to your highs again. And again, I know a lot of people see 5,600 area as the high. High close was 5,300 plus, matched again in March, 53. Don't go back to the high close again.
Repeated failures at the same level aren't weakness. They're pressure building beneath the surface. As Michael Oliver points out here, silver testing $90 three separate times suggests supply is being absorbed, not reinforced. In market structure, the more a resistance level is tested, the weaker it becomes, especially when momentum indicators already flip bullish. What's rarely acknowledged is that breakout moves often come when skepticism is still high, not when consensus turns bullish. For investors, that means the next move above $90 could be far more aggressive than expected.